So, welcome back again, friends. In this part 5 of fundamental analysis, today we will cover some of the important topics which are very essentials. So, never miss this video and don't skip it. Watch it till the last. So, first is the retained earning. So what is retained earning? Retained earning is nothing but net income minus the dividend. So what companies does is that whatever the amount is balanced after the PAT minus dividend, year on year it gets accumulated and it forms the retained earning for uh, many years or past history. When you show it as a percentage of total earning, it becomes a retention ratio. Okay. Now, how these retained earnings are good for the company? Firstly, the company can use it for payment of dividends or bonus issue. Secondly, it can also use it for investing back into the business. Then again, it can use for launching of new product or creating a new vertical. Also, it can use it for mergers and acquisitions, buying a new company, or maybe buybacks. Company can use it for buying their stocks back from the public, and they can use it for repayment of the loan. So if the company is having retained earning, that means company is doing well, and we should always look for such companies which are having the retained earning. There is no set rule that retained earning should be this much or that much, but if the company is having retained earning, that itself is a good sign if you are eyeing to invest any uh, money in the stock. Okay, so one more parameter is that one way to assess how successful a company was in using the retained earning is to look at the key factor called retained earnings to market value. Okay, so it is RE divided by market value. Okay, so it is calculated over a period of time, usually couple of years or more, and assess the change in stock price against the net earnings retained by the company. So this is one more thing you can compare. Now next we see the margin of safety. What is margin of safety? So margin of safety is nothing but the factors we must include in our fundamental analysis. These factors will guide us or maybe protect us from the uh, going company. Maybe you must have seen the fiasco of Satyam. So Satyam price was some time back, it was 400 and it came to zero. Okay. So this kind of fiasco should not happen to any of us. So if we keep this margin of safety factors in check, then we are sure that we have invested in a company which is having the margin of safety and we will never get into the trouble. So we will go, there are three margin of safety factors. First is the free cash flow, second is the self-sustainable growth rate, and third is the earning yield. So first is the free cash flow. So what is free cash flow? Free cash flow is nothing but the cash from operating activities minus the capex. Capex is capital expenditure. So whatever company is having some works, capital works, like building a maybe factory building, expansion, or a new project. Anything is capex. So free cash flow is CFO minus capex. Now this free cash flow to CFO, this ratio should be always greater than 0.1, or you can say 10% of CFO. Free cash flow should be 10% of CFO and above. This is a very important factor because if the company doesn't have the free cash flow, then company will always rely on external debt for doing anything in the company. Anything in the sense for production or maybe payment of dividends also they sometimes take debt. So it is better to have free cash flow so company doesn't have to go for this debt. So it can provide important insights into the value of a company and health of its fundamental strength. If the companies have a free cash flow, then the company's financials have to be are said to be stronger. And this is also a starting point for if we want to become a shareholder of a company or maybe lenders to evaluate how the company is performing by looking at its free cash flow. So uh, now there is one more term called free cash flow to equity. This is nothing but CFO minus capex plus net debt. Okay, net debt means debt minus debt paid. So it is net debt. So this we will see in uh, next few pages how it is useful. Basically, free cash flow to equity is the free cash flow which comes to the equity stockholder in the in the form of maybe dividend or bonus issue or something like that. So this is a free cash flow to equity. Now next we will go to the self-sustainable growth rate. Now what is self-sustainable growth rate? This term is not very much popular in the market, but I'll tell you one thing. It is basically there is a growth rate in the cash, and this cash in turns support the company operations. So basically you can say the company is self-sufficient in terms of cash. So they don't have to rely on external debt. And this is a very good point, very important point, because uh, you must have all seen that in times of COVID-19, a lot of companies got shut. Okay, why? Because they were sitting on a debt when there was no movement everywhere, so companies were not able to sell their products and they were not able to generate enough profits and enough operating incomes to support or payment of this debt, both interest and the principal. And in turn, the debt burden kept on increasing. So finally, they had to close. So if the company is having this SSGR, and through SSGR, its company is surviving its operations, then there is no requirement of external debt, and this is a very good factor for the company. Now let's see the constituents of the SSGR formula. First is the net profit margin. It should be greater than 8%. This NPM is nothing but PAT divided by sales. This shows us the net profit margin out of sales. Okay. Next is the dividend payout ratio. This is nothing but 1 minus the retention ratio as we saw earlier, and net fixed asset turnover. If the fixed assets are getting turnover, what is the net of that? So SSGR formula is in the bracket NFAT into NPM into 1 minus DPR minus the depreciation. If you multiply it with 100, it comes into the percentage terms. Now this SSGR should be greater than the sales growth of the company. Say for example, if company is doing 100 CR of sales in 2023, and if next year in 2024 the sales grows to 110, so it is a 10% increase. So if company's SSGR is say 12%, that means entire operations of the company, it is fed through SSGR, and it is a sufficient margin, 2% extra margin is available. So even if the company's operations get a hit, the company is able to sustain its operations. Okay, so if you see the comparison, if SSGR is greater than sales growth, like in this case, so it will be having low or nil debt. This is the first sign. You can observe this whenever you see the any company. Now, next, SSGR is less than sales growth. So company will rely solely on debt to fund its operations, and the debt levels will increase. Okay, or maybe higher. And third is the SSGR is less than sales growth and debt is reducing. Why? Because SSGR is funding some of the sales and also it is paying for the debt. So debt is reducing. So it also improves the interest turnover ratio. Okay, this is also a sign that you can see the any company's interest turnover ratio is improved, where this SSGR is uh, maybe less than sales growth, but since the debt is reducing, so it is improved ITR. Also, you can check through receivable days and higher CFO than PAT and positive cash flow of from investing. So these are all signs. We can check how SSGR affects the company. Okay. Now next we comes to the uh, there is no set exact figure, but the SSGR should be greater than the sales growth. Okay. Now next we come to the earning yield. What is earning yield? Earning yield is nothing but a earnings per share divided by stock price. So it gives us a, if you multiply by 100, it gives us a percentage. And if this is higher than the Government of India 10-year bond yield. So what is the present 10-year bond yield? It generally ranges from 6% to maybe 6.3 to 6.4 percentage. So if any company's earning yield is more than this, that means at least you will get this much of yield out of your investment. Okay, so this is again a one metric of factor of safety, that you are rest assured that the earning yield is higher than the normal returns of the Government of India 10-year bond. Now, next we come to some of the financial scores, as I mentioned in the channel. Let's go one by one. So first is the Petrosky X score. It is basically there are nine parameters, and if the score is 7 or more than 7, 7, 8, 9, it is considered as excellent. Okay, so there are three major headings under which these nine parameters are spread across. First is the profitability. So it should have a positive net income. Then ROA should be higher, CFO should be higher, and CFO should be greater than PAT. Okay. Now second parameter is the leverage, liquidity, and source of funds. So debt ratio. Second is the current ratio, and third is the there is no equity dilution compared to previous year. Okay. Now third is the operating efficiency. So how is operating efficiency is measured? It is measured through gross margins and what is ATR? Asset turnover ratio. Okay. So these two factors will give. So whatever factor is positive for the company, it will give a score of 1. Otherwise, it will give a score of 0. So if you add all parameters are giving positive or 1 number as a result, so the total score will be 9. There are some maybe 7 ones and 2 zeros. Then the final score will be 7. So likewise, this Petrosky uh, F score is measured. Now, after that, second is the Montier C score. Now, original uh, the C score was 6 parameters. Later on, 3 more parameters were added. So to make it a total of 9 parameters. So this 3 additional parameter was added by a leading research firm which thought that 6 parameters are not sufficient. So let's add 3 more. So what are these parameters? Divergence between CFO and PAT. This is first parameter. Okay. So if the uh, divergence is growing between net income and cash flow, it will give 1. Okay. So accordingly, then next is the receivable days. So if the receivable days increasing, again 1 number. Inventory days. So increasing inventory days also gives 1 point. Similarly, next is the current assets, then depreciation, assets growth, and the 3 assets, the 3 parameters which were added later on is debtors divided by revenue. Okay, this is the ratio. Is it increasing or not? That means company is selling more credit and not realizing cash. Asset quality, if the asset quality is improving or decreasing, and accrual ratio. Total accrual is calculated as change in working capital other than the cash and less the depreciation. That is called accrual ratio. So now in this is the reverse. All bad parameters will be given 1 and good parameters will reflect 0. So if the score is 7 to 9, that means it's a red flag. So 0 to 2 is best. Okay, in this, you just remember this. It is a reverse compared to Piotrowski F score. Now we come to the Altman Z score. So there is a formula 1.2a plus 1.4b plus 3.3c plus 0.6d plus 1.0e. Now what are A, B, C, D, E? A is the working capital divided by total assets. B is the retained earning by total assets. C is EBIT by total assets. D is equity divided by liabilities, and E is sales by total assets. So this Altman Z score gives us some number. So what should be the number? So it should be closer to 1.8. Okay, just remember this. So if the score is less than 1.8, that means company is headed for bankruptcy. As per this ratio, whosoever is found out this Altman, okay, and while if it is more than 3, so it is not likely to go bankrupt. Okay, likewise. So it should be, we can say it should be above 1.8 and up to 3, because more than 3 is also good, but it is better to have it is as close to 1.8 as possible, because it is an ideal ratio. Okay, so now we will see some quality and quality scores of the company which we have seen in the our channel, and these scores are very important in finding out how the company is in terms of its uh, handling of the accounts. Okay, so let's see this one by one. So first we will see how the greatness score can give us the insight into the company. So basically creating shareholder value by optimum utilization of cash which is used into capex, and this capex in turn generate the profit which gets again utilized for return of surplus cash to shareholders. So this core, the greatness score or great good company score tells us that how effectively the company is using the shareholders' equity and with optimum utilization of its assets in generating profits, and which again comes back to the shareholders. So basically it helps generate returns for the shareholders. So what is cycle? Invest capital, generate sales, sales to profit, profit to free cash flow, invest free cash flow again into business, or gives you dividend oblique bonus. Okay. So this is only possible when it is done on a sustained period of time. And let's see the clean score. Now this clean score identifies stocks with a clean corporate governance by proper accounting practices. This is very much useful because it reduces our downside risk. This protects the capital and this protects us from the downside risk. Okay. So what all things it checks? If somebody has manipulated the P&L statement, then again if somebody has done some mismatch checks in the balance sheet, any pilferage check, and if the audit has done it uh, checks properly. So audit quality check also is getting checked in this clean score. So this is very much useful because if we are buying a company and all companies have a chance to go from 100 to 0, even Satyam was not left out. So this clean score, if it is good, that means you are rest assured that at least if the stock price is not moving up is okay, but it will not go to 0. So this is a very good score. Now let's come to one more uh, important factor which we called as a Graham number. So what is Graham number? It was basically coined by a renowned investor Benjamin Graham. So what is the formula? Square root of 22.5 into earning per share into book value. In this, the PE as per him should be 15 or less, and price to book value should be 1.5 or less. If you multiply this 15 into 1.5, it becomes 22.5. So this is the ratio is justified in this manner. So what Graham number tells us, if the stock price say 100 and Graham number is suppose 95 or 98, and this stock is very close to the Graham number and you can buy this stock. But if the stock price is 100 and Graham number is just 50, that means you are paying very high price, and over basically it is an overpriced stock. Okay, this is the Graham numbers significance. Now there are two methodology by which you can find the intrinsic value of a stock, and this method is called discounted cash flow analysis, DCF. This is a very difficult and very detailed process. It is not easy for anybody to explain it to you in just 5 minutes video or 10 minutes video, but anyhow I'll just give you insight of this. There are two methods. First is the dividend distribution model. Now there are two-stage DDM or three-stage DDM. This is for companies which distributes dividend. So in two stage, there is a company grows and then stabilizes. So this is stage one. This is stage two. Now there is one company which grows stage one. After some times, it reduces the space of increase of the growth maybe, and then it stabilizes.